Hey everyone, welcome to the first video of the Tax New Zealand core content walkthrough. So Unit 1 is about tax fundamentals of New Zealand, so it's a bit of a general overview, giving context as to how the tax system works and generally how is assessable income, deductions, tax, credits, things like that work. So the New Zealand income tax framework has 3 stages. So number 1 is just calculating your taxable income. Number 2 is calculating your income tax liability, and number 3 is calculating your terminal tax payable. So what do these actually mean? Well, let's make use of this diagram down below. So your assessable income is kind of self-explanatory. It's all the money that you're coming in, which is assessable for tax purposes. Now, not every dollar that you receive in your bank account is going to be assessable income, and vice versa. You can also have some items which are assessable income, which you need to record as income, which you haven't received the cash for. It really depends on the laws of New Zealand, and we'll learn about that in more detail. And if you also need help kind of understanding what exactly and what specific items are assessable and which ones aren't, you can actually use the the tax rec guide from our notes over here, and that actually has a list of pretty much every item that you can come across in an exam, and the tax treatment and the relevant legislation for that as well. So for example, we can have a look at, it's got expenses as well, so to figure out if it's an allowable deduction, but it's also got different types of income in there as well. So for example, commissions, deferred employment income, and it just tells you how to treat it in here, and the relevant section you need. Dividends, for example, it also tells you about the timing. So for example, assessable in full when received by a New Zealand resident taxpayer, but there is an exemption if it's derived by a New Zealand resident company. But we'll cover this in a later chapter. So that's just a little bit of general context as to how you figure out if something's assessable or not. So that basically gets to your annual gross income, right? So the next thing is you've got to figure out what expenses you can actually deduct against that income. And the income, it's also important in the tax module to be aware of what the relevant sections are, because whenever we're writing in the exam, it's always best practice, just for the tax module, not necessarily for the other modules, just for tax, to put the relevant legislation section over here. So for example, if it's assessable income and we're saying why dividend is assessable income, we would write per section BD1. Now, similar story for deductions. We also need to figure out what is an allowable deduction. So for example, let's say you have a job and selling widgets. The sale or the revenues from selling those widgets will be your assessable income, but you'd also be allowed to deduct any cost which would have a connection with you reporting that income. Now, it's very important that you do have a connection with that income, otherwise generally you won't get a deduction for it, but we'll talk about that in detail later on. So that's generally under section BD2, unless there's a more specific provision applying to that deduction, then you would use the more specific one. So then you get to your annual gross income and your annual total deductions, and this equals your net income. However, if this is a negative, then you have a loss, right? And we'll talk about what you can do with losses a little bit later on, but you can carry forward or you can offset it against your current year income. So let's say you've got a prior year loss. So let's say this year you've got a positive income, say $100,000, but the previous year you lost $100,000. The next stage is your taxable income. It's basically a difference between your net income and any losses that you have available. So in that example, if you've got $100,000 of carried forward losses, you could reduce your net income to 0. So you might have $100,000 net income, but a 0 taxable income. But at the end of the day, this is what your tax payable is calculated based on. So calculating the income tax liability is the next step, and of course the starting point is this taxable income where we got to over here. So to calculate your tax payable or your tax liability, you basically apply your basic tax rate against your taxable income. And that's going to equal your income tax liability, what you have to pay to the government. So how do we figure out what the basic tax rate is? We'll go through what each of those rates are in a moment, but basically in New Zealand there's a marginal tax rate system. And what that means is, unlike a company tax, which is just flat 28%, which means if you're going to earn $100,000, you're going to pay 28.5%, right, of that amount. But if you're going to earn $1 million, you're also going to pay 28.5%. So it's basically a straight line going up. So no matter how much you increase your income, you're going to pay 28.5% of that, and vice versa. If only you have a small amount of income, you're still going to pay 28.5% of that. But marginal tax works by basically making the rich pay a little bit more. Well, people who earn more salary, they pay a higher rate of tax, versus people who earn low salary, they pay a low rate of tax. So we actually have this threshold down here where it's a very low rate of tax if you're only on $14,000 a year. But the benefit is everyone gets access to these. So as you calculate it, you basically add up your first $14,000 and apply a tax rate of 10%. Then your next $14,000 to $48,000, you'll then apply 17.5% on this, just the 14 to 48. So they're basically the $34,000 there. And if you earn more than that, you'll calculate, an additional amount for this. Any amount between 48 and 70, you'll apply that at 30%. So even though the top tax rate at 70,000 and above is 33% for individuals, the actual tax rate, once you average out all of those different calculations, is a much lower tax rate than 33%. So it's not as high as it sounds, but we'll come back to that. So of course, it really depends on what type of entity you are. So obviously I was talking about an individual there, and I also gave reference to companies paying a flat tax rate, but it really depends on what type of structure. Are you a sole trader? Are you an individual? Are you a company? Are you a trust? Are you a partnership? Are you a charity? So we'll talk about what those implications means, but basically there's a different tax rate depending on the different types of structure. Okay, so we know how much your income tax liability is. So let's say you're a company, you've got to pay $28,500 if you've got $100,000 income, or an individual, and I won't be able to do this in my head, but you've got to pay, let's say, $20,000 if you're an individual. That's your income tax liability. So this is stage 2. So the final stage 3 is, do you have any, credits that you can offset that amount? Because this is the final amount that you actually pay the government. So this is what it says in your bill, but you've actually got a credit for whatever reason. So we're going to reduce the amount of cash that you actually have to pay, because it's kind of seen like you've already paid that money to the government. So it's just sitting there on reserve, and they're just saying you just do the top up, which is this, the terminal tax over here. So let's talk about tax credits. So tax credits need to be used in a particular order, and we'll cover this in more detail a little bit later. But some example types of tax credits that you could use to effectively reduce your tax payable is any non-refundable tax credits, credits for supplementary dividends, imputation credits, or remaining credits. So even though you haven't personally paid that cash has been paid on your behalf, and that's usually by withholding an amount. So for example, when you get your salary, they're going to withhold PAYG, right? It means even though you've got a salary of $100,000 a year, you're not getting $100,000 a year. You're only getting $50,000 a year in cash, right? So that difference is just being withheld and given to the government. Same thing with imputation credits. So if you ever pay if you receive a dividend from a company, that company's already paid tax before, right? And the purpose of imputation credits, which again we'll talk about once we get to the companies section, is to prevent that dividend being taxed twice, i.e. the company pays tax on its profits, distributes to you. It's the same money, it's already had tax paid on it. You then pay another tax on that. So the imputation credit, even though you haven't paid for that cash, the company has paid that cash on your behalf. And of course, you might have more credits than you actually need to pay tax. Maybe you've got a lot of deductions and that's reduced the number of tax payable, but you have all these credits for whatever reason, dividends or imputation or remaining credits or supplementary dividends or non-refundable tax credits, whatever reason you've got extra credits. What do you do when you have those excess credits? Well, we'll talk about that in detail later on, but it depends on the type of credit. So for example, non-refundable tax credit, they're extinguished, they disappear. Imputation credits are converted into tax losses or carried forward, depends on the taxpayer. Supplementary dividend credits can be used, research and development credits may be claimed, and other credits will be transferred or refunded. But if you're not sure what any of that means, that's okay, we'll go through it in greater detail later on. Okay, cool, so that's a very quick high-level summary of how the tax system works in terms of how is money assessed, how is money collected, and how does that interact with credits and losses and things like that. So we've already talked about stage 1, calculating taxable income. It's basically the difference between your assessable income less your allowable deduction unless you have losses. And we also talked about over here at this stage, if your deductions are greater than your income, you're going to have a tax loss, right? So what can you do with a loss? So per BC 4, these may be carried forward and subtracted from net income in a future year. So next year, I mentioned before, if you have a 100K loss and next year you have 100K net income, you can reduce that to 0 and you don't have to pay any tax on that. or it could be made available to another person to subtract from their income, but that's for companies, or it could be used in, not individuals, or it could be used in other ways, such as to pay a shortfall penalty. And we'll talk about what a shortfall penalty is later on, but basically the commissioner can say, you've done this wrong, therefore I'm going to give you a penalty, and that can be above and beyond what your actual, tax payment bill is. So we also talked about, once we get to this stage down here, we've got our taxable income, we then apply the basic tax rate per Schedule 1 upon that taxable income, and that will calculate the dollar amount you have to pay to the government. So, and I also mentioned before that depending on what the tax rate will depend on what entity you are. So if you're an individual, you're going to get taxed at marginal rates, as I explained before and referenced down here in the table. If you're a company, you're going to pay a flat 28%. And if you're a trustee of a trust, and we'll talk about trust later, it's a difficult concept, but it's another type of entity, you pay it at 33% if you're a trustee of a trust. So these are the marginal rates of an individual. And these are probably the hardest one to grasp. These flat tax rates are pretty easy to understand. You just times your assessable income by your tax rate. A lot of people think when they look at marginal rates, as I mentioned before, that if you're earning $70,000, you're going to pay 33% on your entire income. That is incorrect, right? That would be a flat tax rate, but this is a marginal tax rate. So the real way you calculate a marginal tax rate is illustrated by this table over here. So we've got this tax resident who's being paid $95,000. And obviously $95,000 is higher than all of these different categories. So what that means is we need to look at each of those different categories and calculate the tax rate for that category, calculate the tax liability for that category, and add up all the different tax liabilities. So as you can see here, their income of $95,000 is higher than $14,000. So for this threshold, for between $0 and $14,000, we need to calculate the tax rate of 10.5%. So all you do is you times the $14,000 times 10.5%, that equals to 1,470. For 14,000 to 48,000, all you do is you times the difference between these two numbers, which is 34,000, by the tax rate for that bracket, which is 17.5%, and that equals to 5,950. And if you don't believe me, let's just do a quick calc over here just so you can see what I'm talking about. It's basically the 48 minus the 14,000. Yeah, there's $1 there, but it's inclusive of both the starting and number. So 34,000, then we times it by the tax rate for that bracket. So you go 0.175, that goes to 5,950. Okay, so you do that for all of the brackets. So you do this one, so that's 22,000 difference. You times that by 30%, that's equals 6,600. And then for anything above 70,000, that's when you just apply the flat tax rate for anything above that. So it's basically 95,000 minus your 70,000, that gets to 25,000. You times that by your 33%, 8,250, and add them all up. So let's see what the average tax rate for this person is. In case you're thinking that this person is paying 33% tax, let's see what the actual tax rate that this person is paying. It's going to be 22,270 divided by 95,000. That's equal to 23.5% average tax rate. So it's fairly reasonable tax system. Basically, a quarter of your salary on average is going to the government if you're being paid around this 9,500K mark. So it's not too aggressive compared to some other countries which are around 40 to 50%. And then the third stage, which is calculating the terminal tax, which we went through, which is basically, this is your tax liability, but do you have any credits which you can then offset against that liability to bring your net payable down. So some of the example credits that we talked about were the non-refundable tax credits, such as foreign tax credits. So this is when you're earning income in a foreign jurisdiction and you get a credit for any tax paid there, you get that money back. We'll talk about that in a later module. Also tax credit for supplementary dividends, which is outside the scope of the module, so don't worry about that. Tax credits for income credits. Sorry, I meant to say imputation credits, which is basically the credit attached to a dividend where a company has already paid tax and they're paying a dividend to you. This is to stop it being taxed again. So how that works is you include the dividend in your taxable income, you then calculate whatever tax you have to get paid, but you also get a credit for whatever company the tax paid. And that way, if you're on a tax rate of say like 33%, let's say you're on millions of dollars a year, 33%, it just makes sure that your actual rate of tax is what's being taxed. So for example, if you're an individual getting taxed at 33%, the company's getting taxed at 28%, you're going to pay tax at 33%, get a credit for the 28%, so you're only really paying a top-up of 5%. So all it makes sure is whoever the final person receiving it pays their full amount of tax on it. Vice versa, if you're earning a lower amount of tax, you get a credit back for it. So basically, that person is only going to pay tax on what the final user is paying tax on. So not a bad system. Australia's got something very similar as well. Quite a few countries have that. And then, of course, terminal tax is basically the difference between your income tax liability and the amount of credits you have. And it's basically the top-up amount that you actually have to pay to the government. Okay, so that's the end of the general overview. Still in chapter 1 though, but we're going to talk about the concept of tax residence and source of income. So the basic principle is that tax residents are taxed on their worldwide income, whereas non-residents are only taxed on New Zealand sourced income. So if I am a New Zealand resident, and this is an important word, resident, I have rental property in Australia, and I have shares in the United States. I will be taxed on all of them. So if I earn rental income in Australia or dividends in New Zealand, in the USA, even though I don't live there, but I own shares in them, I need to pay tax on that income in those other countries. Now, you will get a credit for any tax paid in those countries, provided there's a double tax agreement, but we'll talk about that a little bit later. But the principle is, if you're a New Zealand resident, you are responsible for all income globally. You can't just put it in some low tax jurisdiction and avoid tax, right? If you want to live here in New Zealand's hospitals and roads and police, etc., you need to contribute for that regardless of where you're earning your money, as long as you're a resident. That's the key word, resident. But if you're not a resident, right, and we'll talk about how do you determine if you are a resident or not, you're only taxed on your New Zealand sourced income. So for example, if you live in Australia, right, or you live in the United States, but you own shares in New Zealand, like with that zero, and you get dividends from that, you're going to get taxed on any income earned in that country, New Zealand, but you're not going to get taxed on your own income in Australia, correct? So you live there in Australia, you generate income over there, why should New Zealand tax that? Doesn't make sense. But if you're going to earn money here, we need to make sure that income is taxed. So that's basically the principle. So in order to understand that, we need to know what the two key concepts of that were. The key concept was residency, right? Because that's going to determine whether you're paying tax in New Zealand or not, depending on where that income is located. But the other aspect of that is knowing where the income is located, because, for example, especially for non-residents, right? Because if you're a non-resident, it's very important the distinction of what constitutes whether it's been earned in New Zealand or overseas. And especially in this digital age, the line can be blurred more and more, right? For example, what if you're living in New Zealand but selling a digital good to someone in India? Did you earn that income in New Zealand, or did you earn that money in India? So we'll start to talk about kind of what the rules are for determining where that income is sourced, and also how do you know if you actually are a resident? Do you have to live there to be a resident? What happens if you have a house there but are away for most of the year? So these are the kinds of questions that we'll be asking. So just to kind of extend on this point here in terms of how are residents and non-residents taxed? So we obviously covered off that residents are taxed on worldwide income and non-residents are taxed on their New Zealand sourced income. But some of the other key differences are that residents are on New Zealand sourced interest and dividend income may be subject to withholding taxes. So basically the government will withhold taxes from that dividend or interest, very similar to how they do that for your wages. Whereas if you're a non-resident, New Zealand source interest and dividend income may be subject to NRWT, which is another type of withholding tax, which we'll discuss a little bit later on. So a lot of this probably won't make sense to you yet until we actually come across the subject. For example, what a CFC is, what a FIF is. Don't worry too much about it. Once we cover off those topics, we'll come back to this table. It'll make a lot more sense. But it's good to have in your notes just when you go on the exam, and once you're across that core content, you'll be like, okay, this is a good summary table for me to refer back to it. So I might just skip over this for now because it won't make a lot of sense quite yet. So let's talk about what the general rules are to determine if you're a natural person, i.e. a resident. So in essence, it's basically where your abode is. So what is an abode? It's basically, the way to think about it is, where is your house, right? Where do you live? But its definition is a little bit different to that, and we'll talk about that in a moment. So the three key rules for determining where the tax residence is of a New Zealand person is, number one, permanent place of abode. So if they have a permanent place of abode, or PPOA, in New Zealand, and we'll talk about the specific definition of what that means but it's basically a house that you live in, they'll be a tax resident regardless of whether they have a PPOA elsewhere and regardless of the time they physically spend in New Zealand. So if you have a house and it's deemed to be your place of abode, regardless of whether you're there or not, and regardless of whether you have PPOAs elsewhere, you're still deemed to be a New Zealand resident. And we'll talk about some specific cases where you might be thinking, oh, that's a bit weird, like they haven't spent most of their time in New Zealand, but they're still deemed to have a permanent place of abode. Obviously, these rules are drafted by the New Zealand government, so they want to capture as many different scenarios as possible, because that way they're going to get more tax, which is why it's more favourable to the government in these kind of rules. Next rule is the 183-day presence rule. So basically, they're a tax resident if they are personally present, i.e. they're actually in New Zealand for more than a total of 183 days in any 12-month period. And when I say rolling 12-month period, they mean instead of a financial year, which might go to March year end, it's basically what's today, and then 12 months immediately prior to today. Okay, just to avoid confusion with a income tax year. And do not maintain a PPOA. Oops, sorry, reading the wrong one. In this case, a person is still treated as being a resident from the first day of that 183 period. And the next rule is the 325-day absence rule. So basically, and this is a negatively worded phrase as opposed to saying this person is a resident if they're in New Zealand for more than 183 days. This one's saying they will not be a tax resident if they are away from New Zealand for more than 325 days in a 12-month period. And they do not maintain a PPOA. Because if they maintain a PPOA, then they will be a tax resident regardless of time they spend in New Zealand. So this is the most important rule here, because if they have a PPOA, then it doesn't really matter about time at all. But if they don't, then you start looking at time and saying how much time have they actually spent in New Zealand. Okay, so just before we start going through this PPOA, there's a couple of other terms which are important. So domicile and residence. It's not as important as PPOA definition. This is the critical test. And as you can see here, the overriding test is whether the person has a PPOA in New Zealand. And this is just saying that basically what I mentioned before is obviously because these time rules don't matter if they have a PPOA. So this is the primary test. And if they don't have a PPOA, then you can start considering these rules because otherwise, it doesn't matter how much time they spent. If they have a PPOA, then they're a tax resident. So, but just quickly, what a domicile is, it's basically a term established in common law. And what common law is basically in the courts, right? People have gone and sued people, in these grey areas, and the judges kind of help clarify these areas by defining, certain, terms and definitions and concepts. And domicile is one of those, grey area terms which the courts have, determined the definition to be. So basically, what the courts have determined is that an individual can be a tax resident in more than one country at any time. So you can be an Australian resident and New Zealand tax resident, but you can only have one domicile. So tax residents also can change year on year, whereas domicile is generally fixed. So, for example, if I'm Australian, I go travelling around. I've spent 25 years of my life here, whatever it is. I then go travelling around New Zealand. I'm in New Zealand for 2 years. I would be a tax resident in New Zealand because maybe my abode is there, and maybe I've spent more than 183 days there. But my domicile is in Australia because that's where it's where my attachment is, right? It's where my permanent attachment, not just temporary or short term. But it's okay, this term doesn't come up too often. Just wanted to distinguish between what residence means and what domicile means, basically. So, as I mentioned before, case law is an important, it's contributed a lot to the definition of what a PPOA is, because tax residency is quite a grey area, whereas some person might think they're a tax resident, whereas another person might not think they're a tax resident, and sometimes, it's a little bit grey. So here are some examples that you can refer to in your exam, and generally when we, have an exam question, we might have to determine whether they're a tax resident or not, because that's going to have implications in terms of calculating their tax liability. We might need to consider the facts of the background information that we're given and make reference to some of these cases and say, this person might have a home there, but he hasn't spent time there. Refer to case XXX, therefore they are not a tax resident and therefore they don't have a tax liability here, but they are assessed on their New Zealand income, right? But whereas if they were a global resident, if they were a New Zealand resident, based on the idea that they do have a PPONE here, they'll be assessed on all of their income. So it's going to make a big difference in the final answer of your question. So important to kind of understand these. So the first case we're going to go through is CIR versus Diamond. I've tried to condense these as much as possible. They're fairly long cases. It's good to have a little bit of background about what goes on in the case, but you don't need to know every single detail about it. Just what's the general principle or outcome that came about out of it. So the general outcome or importance of this case was it demonstrated the importance of these words, permanent and abode. So you can't just have a home available. There must be permanency in staying there. So I could own a property, but if I'm not there at all in a permanent kind of fashion, then it wouldn't be a PPOA. And this case also told us what are some of the factors to consider in determining this kind of qualitative word, permanency. So some of the key things to look for is the duration of the presence, like how long are they actually in New Zealand, what's the durability of their association with that place, if the weather changes, are they leaving? If there's a change in the job market, are they leaving? Or are they there through thick and thin? That's durability. And then the closeness or otherwise of taxpayers' connection with the dwelling. This is a hard one to kind of say. What's their connection? I guess how much have they decorated? Have they got a lot of furniture? If they've just got an apartment with one piece of furniture, then they obviously don't have a lot of connection with that dwelling. And that the existence of another place of abode outside New Zealand does not preclude, i.e. prevent, the taxpayer deemed to have a permanent place of abode. So you can't just say in the court system, this can't be my permanent place of abode because I've got an apartment in Australia. But the court's saying, well, you spend most of your time here, you've decorated it out, you've obviously spent money and time decorating it and gardening and whatever it is. You've obviously got a connection with the building, therefore this is your permanent place of abode, even if you've got other properties. Next case is Van Uden versus CIR. So the key outcome of this case is that the abode does not need to be the home solely lived in and should be assessed in the context of objectively factual circumstances. So you could have lived in several homes throughout the year, but you could still be deemed to have a PPOA in New Zealand. So another key outcome is that this case demonstrated that any money that you spend while staying at the property can make you seem like you've got a permanent place of abode there. So, for example, if you spend money on tools or fixing up the property or spending money on plants, etc., and putting it in the building, that can be evidence that you have a PPOA there, even if you spent most of the year overseas. And interesting, this case also brought in discretionary spending. I think this guy was spending money on haircuts and things whilst in the area, and the court said that could be used to indicate that you have a connection with this property and therefore a PPOA. Then we've got this next very cleverly and creatively named case called Case F139. So this is about a person who returned to New Zealand to resume working for his previous employer. So he was away for 10 months and he'd spent most of that time he'd severed most of his ties with New Zealand on leaving. So, he left his house, left his belongings. But the fact that he had loyalty to his former employer when he returned to the employer when they had an unexpected staffing shortage was a relevant factor in assessing his connection with New Zealand. So you might have seen so far that connection is an important word so far when we're determining PPONE. It's about, do you have a connection to this property? Do you have a connection to this place? So the court's arguing that this connection is the fact that he felt bad about his employer. Right? He was helping out his employer. May not have been his best interest to come back to this country because he's obviously severed his ties. So the court said, you've got a connection, therefore you've got a PPONE in the country, and therefore you're a resident. It's not very fair on him. Next case is Case H97. The concept of staying out of New Zealand for a substantial period of time is not consistent with having a PPOA in New Zealand. So it says not inconsistent. So it's saying it is consistent with having a PPONE. So basically, just because you're outside of New Zealand for a long period of time doesn't mean that you don't have a PPOA in New Zealand. So, and this kind of feeds back to this rule that we talked about up here, is that ultimately the key factor is whether you have a permanent place of abode. And if you have a PPOA here, then this timing thing doesn't really matter, which is what this case is saying here as well, is that even if you spent most of your time overseas, it doesn't really matter if you've got a connection to New Zealand, then you've got a PPOA. So this guy, he lived overseas for a long period of time in a construction camp, but the connection was deemed by the court because he had wages paid to his New Zealand bank account. He also stayed with his parents in New Zealand, particularly on the fact that his parents was like a fallback house, and the overseas contract was only for 6 months with a right of renewal, not a guaranteed renewal. So he was kind of deemed to have a connection because he was like, well, if this falls over, I'll just get back to my parents' house. That's my fallback plan. That's a connection. Therefore, PPOA. Next case is case J41, and this says that it's a double tax agreement, and what that is it's agreement between two countries talking about certain tax issues. So, for example, if between Australia and New Zealand says, well, what happens if you've got an Australian, what happens if you've got an Australian resident earning money in New Zealand, or vice versa, where you've got a New Zealand tax resident earning money in Australia? Who gets first taxing rights? What's the withholding tax on those? Can I claim tax on that as well? Do I get first taxing on it, and so forth, right? So there's a lot of great issues to figure out. DTA is an agreement which kind of sorts those things out between the countries. So this case says that a DTA determines the residence of a person who's found to be a dual resident. So the DTA between UK and New Zealand states, which was the relevant for this case, that the resident is determined on the basis of the country in which the taxpayer has a permanent home available. In this case, the taxpayer failed to prove that his New Zealand home was not available to him and therefore was found to be a resident in New Zealand for the purposes of the DTA. Also relevant is the fact that the taxpayer made representations in UK Revenue Authority stating he was not a resident for United Kingdom tax purposes. So it's basically just saying DTA can determine your residence. Then the final case that we're going to go through is Q55, and this is about a taxpayer who was on sabbatical leave, and they were found to have a PPOA in spite of renting out his family home during his absence, which was less than 12 months. In this case, it was held that while enduring availability of a dwelling is a necessary part of the test, determining whether someone's got strong ties, the availability of the home is not the only factor. So that's probably the key point here, is that the home, just whether you've got access to the home or not, isn't just the only point. There are other points in terms of how you have a connection. Obviously, the court found in this case, this person had a connection. It doesn't say how they had a connection, whether that was through friends or family or, just proved a connection to the country, regardless of whether the home was available. So the timing test, present for more than 183 days, we mentioned was the test that you go through after these ones above, but obviously if you've got a PPOA, it doesn't really matter. But the third test is that you can lose New Zealand residence, and one of those was the 325-day period that we mentioned above, i.e. this one over here. But there are also some other ways that you can lose residence. So I'm going to skip the 325 one because we covered that. But number one, they do not have a PPOA in New Zealand at any time during that period of absence. So that's definitely the most important test, because if you don't have a PPOA, then you may lose your tax residence. Or are not absent in the service of the New Zealand government and are not a non-resident seasonal worker. So this last point here kind of opens up this grey area as well, is what happens if you're a seasonal worker or someone who's just coming through, whether you're an international student or you're a farm worker, like one of those people who come from overseas to just pick fruit, or you're just coming through on a holiday or, just temporarily. So this is the concept of transitional residence. So this is a natural person who becomes a resident under YD1. They can become a traditional resident, right? And this is a tax concept that allows for a period up to 4 years after satisfying either of New Zealand residence tests. So you do actually have to satisfy one of these tests first of all, but because you have a domicile in another country, see how that word is coming into play now, you can actually come under this specific rule, which so this gives them some concessions that they wouldn't ordinarily be, because any income derived by a person as a transitional resident is exempt if the income is foreign sourced. So as you remember from above, New Zealand residents are taxed on all global income, whereas if you're a transitional resident, it's basically acknowledgement by the government saying, look, I know you're not going to be here forever, so let's not treat you like a resident, let's treat you like an international, basically, even though they've passed the resident test in this short period of time. So basically, the key criteria to be a transitional resident is you must have established tax resident in New Zealand under the PPOA or the 183-day test. So basically, you're a tax resident, as we discussed above, for a continuous period greater than 10 years immediately before the established residence, not had a PPOE or fulfilled the 183. So basically, you're not allowed to have a continuous period within the last 10 years. immediately before they establish the residence. So basically you can't just leave the country and come back and restart it. It's looking at the 10 years before that, before you became a resident. If you were a resident before that period, then you're not a transitional resident. There could not have been a transitional resident before the 10-year non-residence period. So again, you can't just leave, come back and say you're a transitional resident again. It doesn't work like that. And it's just repeating it. So now let's talk about companies, because obviously it's a different test to determine if you're a resident for a company than you are a individual, because a company doesn't have a abode or a home, right? So it's a different test. So now you only need to satisfy one of the 4 tests for a company. A company doesn't need to satisfy all 4 of them. So any one of these will do. So the first one is incorporation, and of course I've got the section reference over here if you need it in the exam, but they all come back to YD2. So the explanation for incorporation is basically a company is a resident if it's been incorporated in New Zealand. So if you've set up your company in New Zealand, you are a New Zealand resident. Next one is head office. So this is looking at the physical location of the head office. If that head office is in New Zealand, you're a tax resident. Number 3 is centre of management. So this is a broader question of whether the management of the company is centred in New Zealand. And this is a bit of a grey area sometimes. If you've got a company like Apple, for example, head office is in the US, incorporated in the US, maybe they're operating a branch entity or just a permanent establishment in New Zealand. So it wouldn't satisfy these ones, so it's more about control and management. Where is that management? Is that delegated entirely from the US, or is there some form of control in terms of managing the day-to-day basis in New Zealand? And you might be able to prove that by saying, you've got local employees, you've got a local CEO, you've got a local exec team and management team, you've got a certain number of staff in the country, therefore the management is deemed to be at the local level. So it's a bit of a grey area. Next one is directors' control. So a company is a resident of New Zealand if its control is by directors, acting in the capacity as directors is exercised in New Zealand. So this is another grey area, and this is focused on whether the management of the company and where that strategic policy decisions are made for the company. So the residence of the company's directors is not relevant, nor is the voting power of the shareholders. Rather, it's where control by its directors is exercised. So does the company fly out its directors once a year in order to make decisions at the AGM? That could indicate that the control by its directors is locally in New Zealand, even though it's got no management locally, got no head office locally, got no incorporation in New Zealand. So any one of these satisfied is likely to capture the majority of companies operating in New Zealand through one way or the other. So the next table is, so we talked about residency and source of income for individuals, but we've only talked about residency for companies. So the other aspect is, as a company, where is that income sourced? But it's not just companies, it's all individuals, companies, it's all entities basically. So the first one is business income. So this is New Zealand sourced income if the business is wholly or partly carried on in New Zealand. If it's partly carried on in New Zealand, you need to proportion the amount that was incurred in New Zealand. And how do you know if it's incurred in New Zealand or not? You can use these kind of tests to figure out if the company is a New Zealand tax resident or not. But looking at where that income is sourced, right? And the relevant case law is Z1, where the income was derived when accrued to the firm before the partner left to New Zealand. So the next type of income is contract income. So this is if the contract is made in New Zealand, or if the contract is made outside of New Zealand but wholly or partly performed. So for example, if you've got a contract to install something, are you carrying out the contract in New Zealand? If so, then it satisfies the latter leg of this. But maybe you're not installing it. Maybe you're installing an offshore rig outside of New Zealand, right? But if you're signing that contract in New Zealand, therefore that income will be derived in New Zealand. This is per YD 3 and 5 and case P17. And next, personal services income. We talk about this later on. And basically, this is income which is, even though on paper it's incurred through a different entity, whether it's a company or a trust. So let's say you own a consulting business and you set up a company because it's got a more favorable tax rate than you'd pay as an individual. What PSI says is, well, regardless of where that's earned, we're deeming that income to be earned by you, and we're calling that personal services income. So then you actually have to pay that at your personal rate, which is a higher rate. So PSI is earned in New Zealand if the amount is earned in New Zealand, even if the employer is not a New Zealand tax resident. Income from land is New Zealand income if it's located in New Zealand. Income from disposal of the property, again, is whether the property is situated in New Zealand. Income derived from the use of personal property in New Zealand, other than royalties. So if it's paid by a New Zealand tax resident or paid by a non-resident for which the non-resident is allowed a deduction, then it's New Zealand income. Interest, okay, if the money is lent in New Zealand, so whether you've put the money from New Zealand to someone else, or the money's been paid to you from an international person but it's located in New Zealand, or if the money is lent outside New Zealand to a New Zealand resident, unless that resident uses the money for the purposes of business, the interest is apportioned to a New Zealand source. Or if the money is lent outside New Zealand to a non-resident, where the non-resident uses the money in relation to a business, they carry on through a fixed establishment in New Zealand. And then dividends, if the company in which the shares are held is a New Zealand tax resident, that would be a New Zealand income. And then finally, royalty. So if this is paid by a New Zealand resident and not made in connection with the business, they carry on outside of New Zealand. Or if it's paid by a non-resident for which the non-resident is allowed a deduction. So ultimately, a lot of confusing rules there in terms of where the income is sourced in determining whether it's New Zealand or not. So ultimately, what we need to do if we have a question like this is figure out what kind of income is it contract income, PSI, income from land, dividend, royalty. Refer back to the table and figure out against the case, the background information provided to us, whether this is income from New Zealand or not. The other way you can do it is just check the TAC-REC guide, which has all kinds of different income, and it has some comments about in terms of where it's incurred as well. Okay, so that's the end of that chapter in terms of residency and source of income. So the next portion, still within chapter 1, is income. So what is income? Really doing a deep dive of this first section in the notes, because yes, we can say income and that makes sense to people on the surface, but there's a lot of questions underneath that. In particular, the key question is it income or is it capital? Right? And that is super important in New Zealand, especially for the purpose that New Zealand doesn't have capital gains tax. Most countries around the world have capital gains tax, and you might be asking, what is capital gains tax? Well, speaking for example in Australia, a lot of companies, because Australia used to be like New Zealand, there was no capital gains tax, and you'd only be assessed on your income, right? So what a lot of companies would do is they'd go to court and say, this money that I've received isn't income, it's capital. And there's a lot of grey areas, as you'll see shortly. And what they said is if they could argue that successfully, they didn't pay any tax on it. But if the court said that's income, then they've got to pay 30% tax on it or whatever it is. So it's a big money difference that we're talking about. So what the government did in Australia, at least, and a lot of other countries around the world, is they introduced capital gains tax to prevent companies from kind of circumnavigating that onto false pretenses and ensuring everyone paid some sort of income tax. So if you get a capital gain in Australia, you pay some tax on it. But in New Zealand, they haven't quite gotten to that stage. They'll get there eventually, I'm sure, where they'll introduce capital gains tax. So that's why in New Zealand tax, it's super important that you understand what the distinction is between income and capital, because if you can argue that it's capital and know that it is capital and can prove that it's capital, you don't pay any tax on it. So let's start off with what income is. It's quite a generic definition. I'm not sure you need to know this specifically, but it's good background information. So we remember from before that it was defined in BD1, and the specific definition of that is any income under provision in Part C. So basically, an income that's been specifically outlined in Part C. And these are the kinds of income that you are aware of and are familiar with, your rental income, your salary, things like that. Now, we've also got this catch-all provision, and catch-all provision is basically if it doesn't fall under this, let's just do a really broad one so that picks up everything else, which you and I would agree should be income, but doesn't fall through the cracks for whatever reason. So this second clause, section CA1 bracket 2, this is a catch-all provision which says any amount which is also income of a person if it is their income under ordinary concepts. So what is ordinary concepts? It's basically developed in the court systems, and these are the basic rules and indicators that something is income, and it can be relevant for this distinction between income and capital because if it satisfies these tests, then most likely it's income. So number one, it's something that comes in, not what is saved from going out. So that would be like, someone's paying you for your services rather than saving more money from cutting costs, right? So it's not the latter, it's the first one. That would be income. That's per read versus CAR. In fact, the first three are read versus CAR. Also the periodicity, recurrence or regularity. So how often is this coming in? For example, your income from your job, you get that every fortnight or every month. Whereas if you're getting a capital event, for example, the sale of a business, for example, that would generally only happen once, right? So that would fail that test if it's a sale of a business. So if it's regular, it's more likely that it's income. Next is quality in the hands of the recipient. And then finally, purpose and intention in that case to acquire and or sell for substantial gain. So whether or not you're trying to acquire and sell something for gain indicates that it might be more on the side of capital, unless you're in the business of doing that, right? So for example, you have people who flip properties, right? So typically the sale of a property would be a capital account, but if that's your business, right, then it would be income. Same with, what's something else that could be capital? So property developers, for example, selling houses is generally a capital event, but if you're a property developer, you're in the business of buying land quickly, developing land quickly, and managing a business in doing that, and doing that on a large scale, and operating that as your kind of structure and business, and advertising it and selling it like that. You're operating as a business, right? That would be income. Anyway, so getting off topic a little bit. So what about the distinction between income and capital? So again, this is developed in the courts, and these are kind of universal laws. They're not laws which are specific to New Zealand necessarily, because all countries have kind of gone through this process as well, including Australia. So Eisner versus Maykomov is a very old one, and it's used in multiple different countries as the fundamental principle between determining whether something's income or capital. So in this court case, the judge likened capital to a tree, and the fruit or produce of that tree is the dividends, rents, and royalties. So for example, the factory, you're buying a factory, that's capital, but your factory then produces Coke cans or manufactured drinks or whatever it is, widgets. The sale of those widgets and drinks would be income, right? Similar to how the fruit produces the tree. The tree produces the fruit. The tree itself is capital, but the fruit that the tree is producing is the income. So, for example, dividends, rents, royalties are all income, whereas the land or property would be capital. Another one is derived from the current operation of the business would be income. That's CIR versus City Motor Service, or periodic, recurrent, regular receipts. This is again pulling from this income from ordinary concepts. So if it's regular, it's more likely to be income. Irregular, it's more likely to be capital. No profit-making scheme outside normal business operation equals capital. Whereas if you have a profit-making scheme, more likely to be a business. So think about the property developer. Their intention is to make profit through the operation of a business. Next is lease inducement payments, reduced rent, contribution for fit-out, income, or CC1B, which reverses this position on lease inducement payments. So this bit's a little bit confusing, basically because initially these three things were income, but now it's capital. And the textbook actually lays it out that way because it wants to show you the progression of how that changed in the courts. But I think for the purpose of this course, so I don't confuse you, we'll just call it capital. One of those specific things. Okay, so one of the things we talked about was business income. So if it's amounts that have been derived from the operating of a business, then it's income, not capital. So how do you actually know if something's a business or not? And it's also important not just from the income perspective, but also the deductions. Because deductions and income, obviously as well, they're only deductible or assessable, depending on whether it's income or deduction, if it's a business, not a hobby. So we need to understand what the distinction is between a hobby and a business, right? So let's say you've got a farm, you go there on weekends, you don't really make any money, you just like to grow trees and garden. Is that a hobby or a business? Well, again, it really depends on the cases, the facts of the case, and we can refer to case law to help us to determine this. But in the case of just doing it for fun, more likely to be a hobby. But if you're doing it for large scale, commitment, time, money, volume, etc., more likely to be a business. So these are the factors to look out for, and these were determined in Gree versus CAR, another historical case. So what are the person's intentions? Are their intentions to make profit, or is it to have fun? What's the nature of the activity? What's the time period? Are they doing it for a long period of time? Do they have a large scale or is it just small scale? Are there a large volume of transactions or small? What's the commitment? How much money have they put in? How much effort have they put in? What's the pattern? Are they doing it just short term or is it long term? What's the financial results? So obviously there is a lot of factors to consider, but there's not one clear answer all the time. But if you consider all the facts and apply these kind of questions, you should be able to figure out whether it's whether you're carrying on a business or a hobby. And here is just another summary table of some of the key cases in this, in determining what constitutes a business. So an organized activity directed at an end result, per agree versus CI would be a business. Intention to make profit does not require a reasonable prospect of profit. So as long as you're intending to do so, doesn't mean that there needs to be a high probability that you make profit. That's per agree versus CIR. And then finally, expectation of profit need not be realized. So you don't necessarily need to actually convert that profit, even if you're expecting it for it to be a business, per case 52. Okay, so let's talk about types of income now. So we know what income is. We know, if it's derived by a business, it's income. We know the distinction between capital and income. Now that we know it's income, what are the different types of income? So there's 4 types in this diagram over here. And obviously receipts which are not income, which are outside this. So that includes capital receipts, which is what we distinguished above, but also windfall gains and gifts. They're not income, right? So you might receive that cash, but you're not assessed on that as income. They're just cash disbursements to you, basically, no tax implication. So the 4 types of incomes are exempt income, excluded income, non-residence foreign sourced income, and assessable income. And this is probably what you're most familiar with, and this is the only one that taxation actually applies to. So we'll talk about what each of these mean shortly. So the first one is exempt income. So exempt income are specific income. So it's listed by statute. So if you're not on this list, then it's not exempt income. And this is under subpart CW and include everything in this list. So I won't read through every single one. You can read through this yourself, but certain dividends, relocation payments, certain types of income of its transitional resident, which we talked about above, pensioners and grants, maintenance payments, scholarships, stake money, certain income of charities, and so forth. So if you get this, not assessable. So the next type is excluded income. So what's the difference between excluded income and exempt income? So these is the types of income which, these ones are specifically listed in the statute, but these ones are income which is generally taxed in another way and therefore excluded on that basis. So it's usually FBT. So usually you pay FBT on something and therefore you don't have to pay tax on that. And that extends to deductions. So for example, entertainment, not getting a deduction for it unless you paid FBT, for example. So here are some of the types of excluded income. Oops, sorry, this is not included income. This is the final category, assessable income. It's basically just what are some other types of categories of income within that. I'm not going to go through this in detail. I'll just probably read through this very quickly, but generally speaking, you don't need to know this off by heart. As you'll come across it, you might get a specific type of income. You then refer to the tax rec guide that we give you, and that tells you kind of how it's treated for tax purposes. You don't need to know this off the top of your head. So I might just skip over that, and we can always come back to them a little bit later. So one concept that you need to know as part of this module is what's the difference between cash versus accrual. It's just general knowledge, and hopefully you've learned that from uni or maybe your job in terms of what the difference is. But just as a quick recap, there's 2 methods. Generally, small businesses have a cash basis, and generally, as you become a large business, you have to do accruals basis. And definitely for accounting purposes, if you have general purpose financial statements, which is what large companies need to do, especially if they're audited, it means that you need to start recording your income and expenses when it's earned, not when it's paid. So for example, people might pay you cash for services that you haven't yet performed. That would be income in advance. So you'd actually have to record the cash and you record the liability, which is an obligation for a future service to provide, but you wouldn't record the revenue. But on a cash basis, you would record it when the money comes in. Again, you don't really need to worry too much about it because we tell you exactly how to account for specific things in the tax rec guide, so you can just refer to that. So in terms of business income, as I mentioned before, large companies generally have to do accruals basis, but if you're generating money from a business, regardless of whether you're a company or an individual as a sole trader, you generally have to report income on an accruals basis, not a cash basis. However, the government does allow you to recognize income on a cash basis if you're a small business. So the specific definition for what constitutes an entity which can do on a cash basis and is small scale, generally for professional skill and personal work, like you might be an accountant, plumber, like small business, right? Expenditure is quite small. Or I'm not going to read through all of them, but generally if it's a small company, and they're all quite qualitative requirements, you can do it on a cash basis. And the general benefit of doing it on a cash basis is it's just easier. And by being easier, it means everything's more efficient. There's lower compliance costs. It's just easier to do. You don't need to worry about timing and prepayments and provisions and things in advance, whatever. It's just if the money comes in, it's income. If it doesn't, if you pay it, it's a deduction. Super simple. But there are some downsides to this, in that, sometimes it can misrepresent what's actually happening in the business, because you might receive cash, think it's income, but it's not really income, or vice versa. Or you might have a whole bunch of, money that you have to pay out in future, and you don't see that on the financial statements when you're looking at it, and you realize down the track, maybe you've bought this business, that you'll have all these obligations which weren't reflected on the balance sheet, because they've already collected the cash earlier on. So in terms of when professional fees are earned, there's this IS 1606, which provides some guidance from the Commissioner in terms of when it is, or when the timing of professional fees are earned. So basically it depends on whether there's an express agreement in place. So if there is an agreement in place that allows them to demand payment for the service, then the income may be derived either during the term of the agreement or the completion of it, depending on when the entitlement, depending on the agreement. But if there's no express agreement, it takes into consideration accounting principles in terms of when the relevant time is to derive that income. Okay, and here we've got a summary of when different types of ordinary income are derived. Again, a little bit of a recap from before, but some of this is important to know. So salary or wages, I'll skip through this quite quickly. When it's received, so when you get the cash for it, or when it's credited to an account. Interest, for interest income, it depends on whether or not you have a financial arrangement, and we'll talk about that later on, not in this chapter, but a very late chapter, financial arrangements. But for most small people who don't have a financial arrangement, i.e. those on a cash basis, it's just basically normal tax principles. So when you've earned it, basically, unless you're on a cash basis, then it's when you receive the cash. For dividends, it's not until it's freed from the company's control, i.e. paid or credited to the shareholder, per this case here. For trading businesses, for income of those trading businesses, it's where goods are supplied, so generally on the sale or delivery of the goods. Or on the sale of trading stock, a debt arises in favor of the vendor. The stock leaves the vendor's account, and the debt for which the stock was exchanged must be brought into account. It's not really helping. It's just this point here, so where goods are supplied, and it's the sale or delivery of the goods, or when a debt is created. So generally it's just when you issue an invoice, right? Because when you issue an invoice, there is now a obligation for you to provide that, and a debt is created to you, because as soon as you issue the invoice, they owe you money. Right? Income from the sale of land arises at settlement. So when a debt that is due from the purchaser accrues, not when it can. So yeah, if the settlement date is when you exchange money, so it's basically then. Income from professional services is when there's an entitlement to bill. And entitlement to bill is generally work in progress, right? So you don't actually have to have issued the bill. It's an entitlement to have issued the bill. So that's why if you work for an accounting firm, they're always super tight about timesheets, is because the journal is debit WIP and credit income. So even though, they're gonna have to pay, they're gonna have to pay money on that in terms of GST and so forth. They need to collect the money, and also they pressure people to do the timesheets because that means more revenue. It looks good on paper. And then we've got long-term construction payments. So this depends on the method used. So you can use one or two methods, which is the percentage of completion method or the the completed contracts method. So if you're doing the first one, it's basically you recognize the income based on a percentage of completion, and the completed contracts is basically when the contract has been completed. So it's either one or the other. And lease inducement payments are spread over the period of the lease. Okay, so let's move on to deductions now, which is the other side of the equation. So obviously if you generate some income, you're going to have some deductions to offset against. So any expenses that you need to pay to generate that income, you can deduct against it. You have to pay income tax on that. So how deductions work is you need to pass these first tests, and you need to not be caught in these second tests. So it's basically positive tests and negative tests. So the first test is called general permissions, and this comes under DA1. And in order to get a deduction, you need to pass these tests. So these tests are, number one, incurred in deriving assessable income, or incurred in carrying on a business for the purpose of deriving assessable income. So let's say you're carrying on a business and you pay an accountant for accounting fees. Can you deduct that? Well, in order to do your business, you need to know how much money you're making, and you need to account for that so you can pay your tax. So yes, this is part of your business. Therefore, that would be satisfied under this clause here, Lim 2 DA11B. Alternatively, if you're an accountant and you work for a professional accounting firm and you need, let's say, self-education expenses, and this is just a requirement of your job, then yes, that would be assessable under the first limb, because you need that in order to generate income under Lim 1. Now the second test is you need to make sure that it's not caught up on one of these. If it's caught up on any of one of these, and these are called general limitations, it means that it's actually specifically non-deductible even if it's passed the first test. So for example, if it's capital in nature, and we went through the test earlier on this module in terms of what to look for if it is capital, the fruit or the tree, for example. If it's capital, then it's not deductible. So an expense can be deductible, whereas the income might not be. So for example, what's a good example? Legal fees can sometimes be capitalized. So if you're running a business generating assessable income, but you then have legal fees in defending your property, for example, you might have to capitalize that cost into the property or something like that. So even though the income might be assessable, the deduction is not if it falls under one of these. Next one is private or domestic. So if there's if the expense is private, for example, eating out meals, but that income is just for your own personal family and nothing to do with business, not deductible. And of course, if there's a percentage that's private, a percentage that's business, you just have to proportion the deductibility of it. So if it's 50-50 private and business, you get a 50% deduction as long as it satisfies its first limb. Next is exempt income. So we talked about different types of exempt income up above. So if the income that you're trying to deduct, that the connection to that expense is to any exempt income, is not deductible. Employment income, to do with your employment. Non-resident passive income and non-resident foreign-sourced income. So we'll talk about that. But basically, there's limitations if it's connected to passive or foreign-sourced income and you're a non-resident. But we'll talk about that in more detail later on. So some of the key terms that are used in these definitions is to the extent and expenditure or loss. And this is kind of self-explanatory, but basically the key point for to the extent is, if there's a private or business component, to the extent basically means what is the proportion, and you only get up to that proportion that it is related to business as a deduction. And similar to expenditure or loss, fairly self-explanatory in terms of what that means, but of course with tax, everything has a definition or a specific deep dive. So it's basically any outgoings which a person has a measure of control usually result in a reciprocal benefit, is generally voluntary in nature. A loss tends to be an amount that is involuntarily incurred, e.g. the theft or destruction of an asset, or has no reciprocal benefit. And then some other definitions, so carrying on a business. So we talked about some of the tests developed in case law which indicate you're carrying on a business, so I don't think we need to go on that any further. Grieve versus Sierra was the main case in that, which developed those tests. Incurred, the definition of that means this person is definitively committed to expenditure, usually this means they're legally liable regardless of whether the amount has been paid or not. So maybe that's the raising of an invoice and a debt, because once that comes about, then you may have a legal obligation to actually pay that debt, and therefore you could say from the other party's perspective they've incurred it. So now what about timing? So what happens if, because obviously to get a deduction, it needs to be connected to assessable income, whether that's your own personal assessable income or if it's business income. But there needs to be a connection, right? So I gave the example of accounting fees versus your business income. So what happens if you've got expenses which are pre the business making money, but it is connected to the business? So for example, startup costs. Right, you're starting up a new business, you don't know if it's going to make money yet, but you're investing money in it. Do you get a deduction? It's obviously in connection with the business, but the question is it in connection with assessable income? So expenses are only deductible where a business activity is being undertaken. So therefore, startup costs are not deductible under Lim 2 because a business has not yet commenced. But if there is a nexus with income earnings, so for example, there's a very short period of time between spending the money in the business generating money in sales, regardless of how much it is, then you could say it's got a direct nexus and therefore it could be a deductibility. So what is the meaning of incurred? Because obviously it needs to be incurred to be deductible, and we touched on this already in terms of the key definition that needs to be definitively committed to. So generally what that means in case law is that there's no way of getting out of it because it's legally liable. So a common situation is that a debt has been raised. So for example, an invoice on one side and a debt on the other. But it's not just the invoice which is triggering that. It's the fact that this means that the other party is legally liable, or another word is definitively committed, right? They have to go through with it. Even if there's no actual payment, eventually they will have to because they are definitively committed. So that's the key definition there. But this case law also broadened that to mean a situation where a person can claim a deduction in anticipation of expenditure. So this kind of feeds into this first point here in terms of pre-commencement and post-cessation. So yes, you can't claim a deduction for startup costs because there needs to be a nexus to income earning. But if you say you are anticipating earnings, you could claim it, right? And similar to deductions, if you are anticipating expenditure, you could claim a deduction for it. And basically the background of this case here is that they had provision for warranty returns. So even though they hadn't actually had to pay any money out for the warranty returns quite yet, they said based on our experience we're expecting it, and the court actually allowed them that deduction because based on their experience they could relatively accurately anticipate that expenditure, therefore they had definitively incurred it per the court. Okay, next concept is no matching principle between deductibility and assessable income. So the character of income to the recipient does not determine the tax treatment of that expenditure to the capital. So for example, if the income, we talked about an example of this before, if the income is business income or just assessable income, the deduction doesn't have to be deductible, right? The revenue and the deduction don't have to both be on revenue account. Like you could have some expenses which are capital and you're based on revenue on income on revenue account, or vice versa, like the legal fees example I said before, or vice versa, you could have a capital amount of revenue, but you could also have deduction on the revenue account, meaning you get to claim the deduction even if the revenue itself is capital in nature and no tax paid on it. So that was determined by Herald and Weekly Times. So capital limitation is one of the general limitations though, because if the expense is capital, if you remember before, one of the negative limbs or the general limitations that we discussed above up here is that if it's capital in nature, you don't get a deduction for it. So in the case that a payment on revenue account is deductible, but it's treated as capital in the hands of the recipient, vice versa, if the deduction is capital, you wouldn't get the deduction for it. So just like there was cases or case law examples or precedents for determining whether revenue was on capital account or revenue account, it's the same story for deductions as well. We need to figure out whether the expense is capital or not. So Sun Newspapers is and Associated Newspapers Limited versus FCT is an Australian case, which is also used in the New Zealand case system as it set the precedent for what determines capital expenditure or revenue expenditure. So the key questions to ask is, what is the character of the advantage sought? So if the expenditure will result in enduring benefit to the person, it's more likely to be capital in nature. So are you buying a business because it's going to provide you a lifelong of income, or are you buying a newspaper, for example, which is going to be in your business and for customers to read, but you'll have to throw it out. So there's no enduring benefit there. That would be on revenue account. Next question is, in what manner is it advantage to be used or enjoyed? So is it once and for all, or is it a short-term benefit? If it's once and for all, it's capital. If it's short-term benefit, think of the newspaper example, it would be on revenue account. And what means were adopted to obtain the advantage? So if the advantage was provided by a single lump sum payment as opposed to a series of recurring payments, more likely to be capital. So similar to what we discussed about revenue, if it's recurring, more likely to be expense. If it's one-off, more likely to be capital. And there was also some additional guidance in this case over here, but ultimately this is the primary case, Sun Newspapers. So some of the additional guidance for capital versus revenue on expense side, not revenue side, this is expenses only, similar but different. Are the sums expended on the profit earning structure, or are they part of the income earning process? And if it's to do with the capital structure of it, then it's going to be capital. What need or occasion calls for the expenditure? So it depends on what the purpose and need for the expenditure is in determining whether it is capital or not. And next, is the expenditure payable out of fixed or circulating capital? This is just an indicator, it doesn't conclude the nota, doesn't conclude it. Is the expenditure recurrent or one-off expense, which we kind of covered earlier before, but if it's one-off, it's more likely to be capital. Recurrent, it's more likely to be revenue account. But again, none of these tests are definitive. You have to consider all of the facts. Whenever we're dealing with a case law issue or a grey issue, we need to consider all of the facts and then weigh up the different arguments and make a case as to whether it's capital or revenue, and then that will be our approach for tax purposes. So in terms of specific types of deductions, these are deductions where they're specifically allowed, even if they would be otherwise disallowed by a limitation provision. So even if one of these says that it cannot be a deduction, these specific ones listed here are still allowable as deductions no matter what, as long as there's a connection to income. So interest and financing costs, bad debts, some legal fees as long as it's not capital, entertainment expenditure, motor vehicle expenditure, repairs and maintenance, premises costs, fines and penalties, or GST. Okay, so the next part of the notes is just going through these in detail and kind of explaining, why they're specifically deductible. I don't think we need to go through that in detail. Of course, what we're going to do is refer to our tax rec guide and then refer to that in an exam. So I think we can kind of skip over these quickly as long as we know that these are specifically deductible in certain situations. I might just have a couple of comments on one of the others. So as long as all of these have a nexus to generating income, they're still deductible even if they're limited by one of the provisions, including capital. So your interest can still be capital and get a deduction. So financing costs as well, bad debts. So note, to get a deduction, the debt must be an existing debt, must be determined to be bad, must be written off during the year. Again, these are all listed in our tax rec notes, so you don't need to know these off by heart. And if you get a tax rec question, basically just pull up it, go off that. You don't need to refer to the notes at all. Legal fees, probably the key consideration is, how much is it, first of all. So if it's less than $10,000, doesn't matter, you get a deduction. If it's greater than $10,000, then you need to start considering whether it's capital or not. If it's on revenue account, you get a deduction, but if it's on capital account, you don't get a deduction. Entertainment. So entertainment is anything, think about like going out to meals, like a Christmas party, getting tickets or a marquee or a corporate box at an event, accommodation, food and drink. So it's basically anything which is like client lunches, parties, that's entertainment. If it's business purposes, like you're going if your purpose of your trip, for example, is a business meeting, that doesn't mean it's entertainment, but it needs to be for the purposes of entertainment itself. So, so all the examples I mentioned before: parties, fun, entertaining clients, team building, things like that. So you need to consider what is entertainment. But basically, these specific examples are 50% deductible, and these ones are 100% deductible. These are specifically defined. So 50% deductible ones are food and drink provided off premises, like a Christmas party, food and drink provided on premises, like a corporate box, holiday accommodation. These are all 50% deductible. So the 100% deductible ones, as you can see, all have a direct nexus to carrying on a business or generating accessible income. So for example, traveling for business, therefore will be fully deductible. Food and drink on premises, including afternoon teas in an office or workshop, right? That's connected to the business itself. Entertainment expenditure incurred and consumed outside of New Zealand. For example, holiday home accommodation, drinks provided to staff on a trip to Fiji, only because it's outside of New Zealand. And then finally, food and drink provided at a conference lasts more than 4 hours. Otherwise, it would fall under this category of here, which is on-premises meal, party, or reception. Okay, now let's talk about motor vehicles, which is another specific deduction. Now, important to note that these rules only apply where there's a sole trader or a partner in a partnership, and it's for the purposes of using a motor vehicle, a private motor vehicle, for business purposes. So this doesn't apply to companies, different. So when motor vehicle expenditure, for example, petrol, repairs, depreciation is apportioned, there's two methods to actually get that for the business side of it. So the first one is the kilometer rate method, and this basically uses this formula down here. But to be able to use this method, you need to actually elect to do so in your income tax return. That includes the latest of the following dates, so April 2017, date which the car was purchased, date which the car was first used for business purposes. And if you don't make an election to do this, you need to do the cost method. So it is very important to actually make the election. Okay, so the formula for the kilometer method is basically kilometers rate times kilometer traveled times business proportion. Like, it's 100% business, it's 50% business. The rates are down here, so it depends on what kind of vehicle you drive. So petrol or diesel, petrol hybrid, electric, and depending on what tier you are on as well. So whether these tier 1 or tier 2 is applying depends on whether you're traveling less than 14,000 kilometers or not. So for the first 14,000 kilometers, you get this premium rate regardless of what type of car you drive. But if you drive more than 14,000 kilometers, tier 2 rate applies to, similar to the marginal tax rate, it only applies on the kilometers above that $14,000. And also, a logbook must be kept. We'll go through that a little bit later to substantiate that deduction. And if you don't keep a logbook, so you need to keep that no matter what. Like, it's not just above 14,000, it's just no matter what. If you don't keep a logbook, the most you can actually claim on your kilometers is actually 3,500. Now, the second method that you can actually use to claim your business expense relating to motor vehicle is the cost method. And this is basically just what's the money that you've had to spend on maintaining this car plus depreciation, which obviously is a non-cash expense, but still an expense that's accruing in the background. So you add up all of the costs, you figure out which is your expenditure, you calculate what your business proportion is, then you also add in your depreciation, which is the non-cash component. So now there's three methods available for calculating this business proportion, because how do you say I've used the car 50%, right? How do you know that? Is it your guess? Is it based on kilometers? Is it based on time? Is it based on a logbook? What is it based on? So the New Zealand Tax Act outlines three methods to do so. The number one is actual records. This means you actually need to keep records of the distance for each journey for the entire income year, and you just apportion it based on that basis. The next one is the logbook. So this is a book maintained for a test period, so you don't need to do it for the entire period like you do for actual records. You basically do it for a short period of time. And then within that period, called the test period, you can then extrapolate that for a longer period, so you don't need to keep maintaining records. So you can do that for up to 3 years based on that limited test period. but we'll talk about the criteria needed to do that down below. And then finally is the default method. So if you get to the end of the year and you realize you haven't kept a logbook and you don't have your records for the rest of the year, you can just do the default method, which is basically the deduction is limited to the lesser of the proportion of the actual business use, or 25%. So if you're not sure what your business percentage is, you just get 25%. So it's all your costs times 25% plus your depreciation times 25%. And it's the lesser of the two. So most people aren't going to say that they've traveled less than 25% unless they're really honest people. So most people just do 25% in this situation. All right, so now we're going to talk about number 2, which is the logbook, because I mentioned before that there's specific criteria required in order to do the logbook method. And now most businesses would prefer to do the logbook because it means you don't need to keep as much records as the other two. You just do it for a short period of time, which is 90 days. And after that, you can just use the logbook for 3 years, right? That's really good. Saves compliance costs. So let me just fix up this formatting. So we mentioned before, keep the logbook for 90 days. After that, you average it out to figure out what's your private versus your business proportion. And then for 3 years, you get to use the ratios that you actually calculated in that logbook, provided any variance of the business's use is less than 20% represented in the logbook. So if the logbook says you use the vehicle 50% and then all of a sudden you start using it 100%, you'd have to do a new logbook. You can't just rely on that again because it's greater than the 20% acceptable variance. So these are the key things that the logbook must record. It must the start and end of the test period, the odometer ratings at the start and end, the distance of each journey, the date of each journey, the reason for the journey, and any other detail that you may be required. Okay, so moving on to the next cost, which is repairs and maintenance. So we're not still under motor vehicle repairs. We're under repairs in general for the business. So this is deductible, but provided it's got a nexus to income. But the key issue is this capital or not? And there's a lot of case law to determine the steps and questions that you need to ask and determine whether or not the repairs is capital. So, for example, let's say you've got a boiler or something to do with making wine, right? I don't know what they're called, a vat, right? Costs you $100,000. Something's not working. The pressure charger, I'm just making up words here, the pressure charger stopped working, so you need to get in a specialist to, go in and make it work again. He's going to charge you 10 grand, and he says, after you do this, it's going to be cheaper than buying a whole new asset, but we need to give you you had an old one, and we need to get you one of the new ones, which has all these extra features, so you're paying a little bit more than you probably need. So the question is that a repairs and therefore deductible because it's an expense, or is this a new capital item, which, like the VAT itself, is a depreciating asset? You get depreciation for it, but you don't get a deduction for it because it's capital. So that's when case law comes in, because it's a bit of a grey area. So some of the key questions is this a replacement asset or a renewal? Is it substantially the whole of the asset, or is it a portion? What's the cost of it, etc.? So we'll go through it in a second. So there's 2 steps involved in this approach in determining whether it's deductible or not. So the first thing is identify the asset. So we need to do this because in some cases, in case law, we've got an issue is this part of the same asset or is this a completely new asset? So for example, with the VAT and the pressure hose, is that a component of the VAT or is that a separate asset, right? So in some cases, if it's a completely different asset, you treat it as a capital item, right? So that's the first question you need to ask is it a different asset or is it something else? This is known as the entirety test, which was developed in the Auckland Trotting Club. Okay, so let's assume that it's part of the same asset as per the entirety test. We then need to consider what's the nature and extent of the work done. And this is when you start asking those questions like, is it a replacement or renewal? Is it substantially the whole of the asset, and so forth. So there's a lot of cases we need to go through, and these aren't just unique to New Zealand. These are global issues that are relied on in court systems. So the first thing is the work done, is it replacement or renewal? Is it substantially the whole of the asset? If so, the cost will be capital expenditure. So if the VAT, we're just replacing 90% of it, most likely just going to be capital. Or if it's just renewal to extend the lifespan, only cost 10K, the VAT's 100K, relatively small percentage, that would probably be expenses. expenditure incurred to repair or maintain an asset that changes the character of the asset. So, for example, if we are, when we installed this new piece in the vat, it suddenly gave us the capability to make beer as well, which previously was just used to make wine. That would probably change the character of the asset and indicate that it's probably a capital good rather than expenditure. But if it's just to kind of renew it and allow it to keep working as is without changing the character, it's more likely to be expenses. And when determining whether the work is capital, the relevant the nature and scale of the work done to the asset. So just delete that, make it a bit easier to read. So if the job is just 2-hour job up and ready, or is it a 3-week or a 1-month installation process? If it's a long process, large scale, a lot of people involved, more likely to be capital, isn't it? Small job is going to be expensed. Does the use of new material just because you use new material doesn't mean the asset is improved. However, whether different materials are used and as a result the asset performs or functions better or differently, this may indicate a change in the character. So ultimately it comes back to this point up here: is is the character of the asset the same? It doesn't matter if the material is different, like I could use iron instead of steel and so forth, as long as it does the same job. But if this new material is this new polymer carbon fiber, which improves cooling costs and saves our electricity and makes the wine taste better, that would be changing the character of it. That would be capital. And then where capital expenditure is incurred, the courts have held no deduction can be claimed for an amount that might have been spent on repairs had the work been carried out differently. So if the installer says, look, we can give you the same piece, it'll get you up and running, it'll cost you $2,000, or you might as well install this new tech. It's going to improve your asset, make it more efficient, blah blah blah. That's different. Therefore, that would be capital, because the option was there to do something cheaper, which doesn't change it, but you elected to do the more expensive and on the side of changing the nature of the asset. That would be more likely to be capital, according to Colonial Motor Co. versus CIR. And then finally, in W.T. Thomas, which is one of the earliest possible cases, the judge held that expenditure incurred to repair a newly acquired asset, so something that's new, if you're buying something new but it's in disrepair, that is not suitable for use, is a capital cost and forms part of the acquisition cost. So let's say you buy a house and the walls are falling down, the roof is falling down. You actually have to capitalize any of that initial repair cost, whereas if it was throughout the wear and tear of the building and you're just replacing it rather than changing the character, it would more likely to be an expense. But because you're repairing it up front, it's indicating that the asset you're buying at a deflated price, because it's not, it doesn't have all of the features that a brand new asset should be. Therefore, you're getting a discount up front, and any cost that you're paying to repair it initially should be factored into the initial cost. I mean, that's the logic behind it. Okay, so premises cost. So a taxpayer may claim their house expenditure as deductible business expense under DA1 to the extent that the premises are used derived assessable excluded income. So if you run a business out of your own house, you can, even though it's your personal property and your main residence, you can still claim a portion of that that you have assessed you need to be part of your business. And you usually do that using the square meter rate. So you basically figure out how many meters of your business of your house is actually used for your business. Maybe it's just your study area. So figure out what the square meterage of the study is versus your whole house. That's your business proportion percentage. And there's the formula there. And it actually gives you a specific rate that you can use by the commissioner, which is 42.75 in 2020. Just plug it in along with your percentage and your costs. That'll get you the rate that you can actually deduct for your premises if you're carrying on a business or generating income. Not salary, but actually carrying on a business from your home. Now here are some other quite specific deductions in terms of what's deductible or not. Again, you can just refer back to the tax rec guide. So fines and penalties are not deductible per IS 0901 because they're too far removed from the income earning process. GST denies the deduction. So we'll talk about GST in a later chapter. It's basically goods and services tax. It's like, if you pay FBT or you pay income tax or GST, you don't get a deduction for those things. That's like getting a deduction for tax, right? Doesn't make sense, right? A deduction is a means to an end to pay tax. Next is prepayments. So prepayments really depends on basically when the unexpired portion is incurred. And what I mean by that is how much of that prepayment that you're paying up front is in relation to the subsequent year. So for example, let's say you're paying for a 24-month subscription for a newspaper or whatever it is. Yes, under a cash basis, you'd get the deduction up front, but per prepayments, especially if you're on an accruals basis, you only get the deduction when it's incurred, not when you pay the cash. So if it's over 24 months, that means only half of that is in relation to the current year, assuming you bought it on the first day of the income year, and the rest of it goes into the next year. And that remaining part, the last 12 months, is the unexpired portion. So generally on an accruals basis, you don't get a deduction for the unexpired portion. So basically how that operates in practice is same result, but the process you do is a little bit weird under section EA3 is basically you allow the entire deduction to be deductible, so you get the entire 24 months deducted in the first year, but you have to add back the remaining unexpired portion into income. So basically you get a 24 months deduction but add 12 months of income in your return. Has the same effect of only getting a deduction for 12 months, but in a weird way. However, we've also got this table down here, which is per determination E12, which lets you know whether the amount is fully deductible even if it's a prepayment. So basically anything in this table, it's got the rules for different items. I'm not going to go through all of them, but it basically tells you the situation where a prepayment could arise and the maximum total amount of the unexpired portion and the time period between balance date and expiry date for each of them. So I'm not going to go through that, but useful information to have in your notes in case you come across it in the exam. But we also cover a lot of this in the notes as well. Okay, next one is deferred payment of employment income. Is another specific deduction situation. So this is basically, so this is what this is talking about is, if you're at KPMG, PwC, wherever it is, sometimes they give you the opportunity to purchase annual leave, and what's effectively happening in this situation is the employee is signing an agreement with the employer in order to forego a portion of their normal salary. So basically they get reduced salary for the rest of the year in exchange for additional paid leave in a later period. So it's a foregoing of annual salary portion in exchange for something later on, generally annual leave. So in order to obtain a deduction for employment income, missing a point here. So when a deduction can be taken for this expenditure if it is incurred but not paid. So basically, in that situation, if you're, not getting, if you're not getting the leave, i.e., you're incurring the expense as a company, but you're not paying it yet, you can still have a deduction for this if it's paid in an income year and it's paid out within 63 days of the end of the income year. It's kind of like a prepayment expense. So next is deductions for payments of employee income of sale of a business. So this is basically any employee income obligations like annual leave, for example, holiday pay. The seller of the business can claim a deduction for that because normally you get a deduction when holiday pay is paid, not accrued. So this is kind of to make sure that the seller of the business who's accrued all that leave for his employees in his P&L and has had that expense throughout all the years isn't left out of pocket, so he doesn't have to. He should get the deduction for it effectively. So that's what that is saying. So as soon as he sells the business, he claims a deduction for transfer of the employment obligations. Next is lease inducement payments. So this is basically, when you move property, whether it's a commercial, lease, to attract someone into the lease, they might give them a lease inducement payment. This is generally a capital payment up front. We'll give you 6 months of lease as a payment. And in exchange, you sign a lease with us for, 5 years or whatever it is. So there's certain rules in terms of when you can actually claim deduction for any, payment of a lease inducement. And generally the deduction is allowed evenly over the period of the land right. So if it's a 3-year rule or a 3-year agreement, you get that deduction spread over 3 years, unless one of the exceptions below applies. Number 1, the person ceased to hold the relevant land right. Number 2, there's an early termination of the lease or license, or where the lease or licenses was entered into before April 2013. So there's some examples in the notes that you can read through in your own time, but it's fairly straightforward. You just get the deduction spread over the period of the of the agreement, unless one of the three exceptions below applies. You just got to look out for them. Okay, so that's the end of Chapter 1, which was Tax Fundamentals number 1. Okay, I'll see you in the next video where we go through Chapter 2.